Good morning, magnificent morning, Melonheads. How we all doing today? Hello, everybody in the chat. Hi, Mom. Hi, Dad. Love you guys. How are we all doing today? Looks like we got another day deep in the red. At least we're set to start that way. Had a little bit of a rally yesterday. Things were looking pretty good for the markets. And they gave it all back. As soon as futures opened up last night, looked like the market was heading for a much lower open. That has held true this morning. We'll see if that's got any steam. It appears that Snapchat was the culprit today. Snapchat. People still using Snapchat? I don't know. I'm a Gen Xer, man. When it comes to social media, I might as well be a baby boomer. No offense, Dad. Snap, don't use it. Not really into Snap. Apparently, it's like, what is it, like a 50 or a $60 billion market cap for a company that doesn't make any money? Actually, pretty symbolic of this whole market, isn't it? That this company with no profitability trades at a multi-billion-dollar multiple, and then they warn like, hey, guys, this is just a reminder. We don't make any money. That was last night. Snapchat came out and said that they're not going to make their earnings estimates, that there's a hiring freeze, which usually means the layoffs are right around the corner. And the whole market reacted to that and came down. It's interesting that a company with no earnings can do that, but hey, that's the way of things. So let's just go right ahead, shall we? And shrink my big fat melon of a head. Let's take a look at markets. Let's take a trip through the futures real quick before we get into this article, because I just want to see what we got going on here. Things are really moving pretty fast this morning. It looks like the S&P is set to open down 40 points or 1%. The Dow is set to open down 178 or about 0.5%. Not a terrible morning for those, but check out tech. Look to open down 1.65% or almost down 200 points, giving back all the gains from yesterday. Again, tech leads the way lower. It looks like we've got no movement yet showing in the 10-year Treasury. So we're down 5 basis points at 2.8. So Treasury yields actually dropping. Again, yields and prices are inversely correlated. You see yields going down. That is prices going up. That is people piling into bonds, leaving stocks, piling into bonds. All right, so what's causing all this nonsense this morning? Well, it is Snapchat. Look at Snapchat right here. Ticker SNAP, down 34% pre-market. And I was really blown away when I saw this number this morning, their market cap, $36.7 billion market cap for Snapchat. For a company that's still losing money, $36.7 billion. And again, like this is this nice, cozy little package that you take everything that's wrong with stock markets and valuations and investor sentiment and easy money and low interest rates and all that, and you pile it up into one company, you get Snapchat. It is the perfect symbol of this market and everything's wrong with it. I might say Rivian is the perfect symbol of this market and everything wrong with it, but today we're talking about Snapchat, so it's Snapchat today. Takes the whole market down with it. Everything, all the social media names are down. Meta. Meta is way down. What a stupid name, Meta. I still don't call it Alphabet. It's always going to be Google to me. But yeah, they're all down too, taking the whole tech market down with it. So that appears to be what is it going on today, and this is on CNBC today. Stock futures indicate the sell-off resuming on Wall Street after Monday's brief rebound, and it was a brief rebound. I mentioned in the during the premiere of my video on diesel yesterday in the live chats that I had gone short the Nasdaq again yesterday. I was actually nibbling on SQQQ calls pretty much all day, a little bit at a time, and they were just heading straight down the whole time I was nibbling at it. But I didn't see any external motivation for the market to be rallying like that. I didn't really see any good news that was out there, so I just started nibbling on those shorts. And here we are. Looks like they're going to open up big this morning. All right, so stock futures fell early Tuesday morning as the market struggled to sustain a comeback rally following weeks of losses. Futures on the Dow Jones, we got into the numbers already. Now here's where it comes down to. Snap shares plummeted more than 31%, now 34%, after the company said it's bracing to miss earnings and revenue targets in the current quarter and warned of a hiring slowdown. Shares of Meta Platforms followed Snap lower, falling 7% in the pre-market, while Pinterest lost 14%. Stocks are getting hit hard this morning, and the main culprit is Snap, warning from Monday evening. The main culprit is Snap's warning from Monday evening. Wrote Adam, something I can't pronounce, of Vital Knowledge. Some are a bit incredulous that a relatively small and perennially unprofitable, ephemeral social media firm can take down the whole tape. But given how sensitive this tape is, Snap is able to punch above its weight. I had to read that a couple times, and you see how I just butchered the pronunciation. Forgive me, it's early. I got to read that sentence again. I just love the language these CNBC guys use. It's great. Some are a bit incredulous that a relatively small and perennially unprofitable ephemeral social media firm can take down the whole tape. Yes, I am incredulous that this relatively small, perennially unprofitable ephemeral social media firm can take down the whole tape. Let's just say this company sucks and it doesn't make any money and all the stocks are going down because of it. See how simple language makes everything easier for everybody? Doesn't make you sound any smarter when you say, I'm incredulous that perennially unprofitable ephemeral social media firms take down the whole tape. Nope, this company sucks. People paid way too much for it. They're selling out of it. It's dragging other companies like it down with it. That's what's going on this morning. All right? The era of big tech is done, folks. Tech is dead. I said it, I think it was back in January on the first disaster quarter from Nasdaq. I called it. It was the end of tech and that there was going to be this big rotation. I've been saying for months, eat and heat. That's where the money is right now. That's where consumers are spending their money because the cost of food, the cost of energy, the cost of lodging or shelter is just going through the roof. And people don't have any money for anything else. All right? That's why it's back to basics. That's why I'm all about commodities, in particular energy, precious metals, food, and it's done pretty well for me so far this year. All right, a couple other things I wanted to take a look at, and here is the VIX, or the S&P, or the CBOE Volatility Index, is currently at 29.2, which is pretty high, but actually subdued compared to where it's been lately. This is looking at about a one-year chart, and you can see these swings in the VIX have been getting bigger and bigger, and we've got this overall uptrend. I've been saying it for a while. Volatility is the new normal. It's going to be here for a while, right? Up 1,000 points one day, down 1,000 the next. Big swings back and forth. Get used to it. It's going to be bad for our blood pressure. If you see a spontaneous live stream from me, it usually means we're on one of those big 1,000-point down days. So we may end up having one of those today. I don't know. I mean, we're looking at a pretty big drop at the start, although not 1,000 points down. And then we've got a lot on the tape today. We've got new home sales are coming out at 10 a.m. And then we've got Jerome Powell is speaking at 12:20 today. Saw that on the economic calendar this morning, and I saw somebody mention it in the chat earlier. This is the economic calendar on Trading Economics. You got new home sales at 10 a.m. coming out. That's going to be a big one because if new home sales come out and they're very disappointing, as they could be, it might be a reality check that, hey, this housing market cycle is officially coming to an end, that we are looking at a big decline in home prices coming up. So that's something that could cause a little bit of panic in the bond market and thus accentuate any sell-off going on in stocks. So keep an eye on that new home sales number at 10 a.m. And then the other big one right here, 12:20, Fed Chair Powell's speech. I had to do a little bit of digging because there's no FOMC meeting or anything going on. And I found this on the Federal Reserve's calendar. And at 12:20 p.m., Jerome Powell is making welcoming remarks in a pre-recorded video at the National Center for American Indian Enterprise Development at their Reservation Economic Summit in Las Vegas. So it's not like Powell's giving like an emergency speech and like he's called a press conference or anything like that. This is pre-scheduled, pre-recorded remarks. Not really sure if we want to expect any fireworks or anything big out of that, to be honest with you. Nothing really jumped out at me. But I did see a little bit of information here, and this is in investing.com. Fed Chair Powell will speak at 12:20, a day after two senior colleagues dropped the first hints of a moderation in the planned pace of monetary policy tightening. Now, this was news to me. Yesterday, Atlanta Fed President Raphael Bostic had said on Monday that the Fed may be able to afford pausing in rate hikes after two more increases of a half a point each, while Kansas City's Esther George suggested a pause could be possible when the Fed funds rate reaches 2%, which again is about 2 50-point rate hikes from here. So we had two Fed presidents were out yesterday saying two more big rate hikes. All right. That's kind of big news, right? All these, the dot plots and everything else, and all these analysts who are calling for 10 more rate hikes through the end of this year, like, that was never going to happen. All right. Never in a million years was that going to happen. The government would be insolvent way before we got to any interest rates near that height. So we all kind of knew that there is a pivot coming from the Fed. There's not exactly consensus on when that pivot will take place. I would say 2 50-point rate hikes from here, probably not a bad guess, to be honest with you, because, man, look at what the market has done since the first quarter-point hike, and then look at what the pace of that sell-off has done since the following or the subsequent 50-point hike. I emphasize subsequent because my dad's always giving me grief about how I pronounce subsequent. So 2 more rate hikes probably sounds about right. I don't think the economy can afford much more before something majorly goes wrong. And hey, look at what markets have been doing for the last, 5 months. Something is really already broken, hasn't it? I mean, we're in bear market territory. We're almost in bear market territory on the S&P. The Nasdaq is deep in bear market territory, going deeper today. So we'll keep an eye out for that. Anything dovish from Powell, any signs of a dovish pivot from Powell will probably send markets much higher. All right. I just want to mention that. Although Powell has not really shown much dovish signs at all this year, right? He made one comment during his last press conference that a 75 basis point rate hike was off the table, and the market ran up 1,000 points and then immediately dumped 1,000 points. So we'll keep an eye out for that. That is at 12:20. Again, if I see anything big happens there, I'll probably go live or do a video about that. We're about 3 minutes away from open, and I see Mr. Mike Binder. Hello, Mike Binder. Thank you very much for the super chat. He says, good morning, Jack. How about some VIX calls? 50 December 22. Wow, that's ambitious, a 50 VIX. Someone from the Fed turned dovish, by the way. Still believe we see some leg up before disaster strikes. Well, I guess you must have made this super chat right before I talked about the other Fed governor speaking. But you're right, Mike. We had two guys from the Fed turned dovish yesterday. Although calling for 2 more 50 basis point rate hikes in the face of what markets have done, not exactly dovish to me. But it's certainly more dovish than some of the analysts' expectations for 10 more rate hikes. And he's saying, still believe we see some leg up before disaster. Well, we may get a bear market rally. I don't think by leg up, I don't think we see another all-time high in markets. Not in this cycle. All right. I think that January 3rd closing, that was the all-time high closing, and it's going to stay the all-time high closing for probably for a couple of years. All right. I think the only way we challenge that high is a major Fed pivot and the money printer starting back up and the stocks just go to the moon, not because of companies becoming more profitable or valuable, but because of the dollar becoming worthless. Right? And I still think we're a ways off from that. I think we're months away from that still. I don't see anything that could take this market to a new all-time high on the horizon other than a Fed pivot. There's just no good. Maybe a very sudden breakthrough at the peace table in Eastern Europe. Maybe that could do it. I don't really anticipate any sudden breakthrough at the peace table, to be honest with you, because leaders on both sides are doing everything they can to escalate. So I really don't see anything that would justify an all-time high in markets right now. The VIX calls at 50 for December 22. I can tell you the VIX calls are very expensive. All right, they're pricey. So if I haven't looked at that particular call, but you're going to pay a big premium for a December VIX call, a big premium. And do we see a 50 print in the VIX between now and December? I would say almost certainly. Will that be a profitable trade? Probably not, because you're going to pay a lot for that, and the theta decay is going to eat away at you over time. It's the one thing I've learned trading VIX calls in these last few months is you got to be really right, and your timing has to be really good. Otherwise, that theta decay really eats you up. So I'm not sure I'd go all the way out to December 22 with those. I tried I try to just, hold off on the trigger finger. Again, not financial advice, not a financial advisor, all that CYMA stuff. But I would try to get a little bit closer timing wise. And when you think, okay, we're now a few weeks away, that's when you make that trade, not between now and December, because the premiums on those VIX calls, they're just going to eat you alive. All right. But thank you very much, Mike. I appreciate the super chat, sir, and the support of the channel as always. Thank you for everything you do for the channel, my good man. And let's take a look now. It is 9:31. The markets are open. Let's see where we're at. S&P has opened down 1%, down 41.3 points. Dow's opened down 144 or 0.45%, a little bit better than the futures were indicating. But the Nasdaq, ouch, down 221 points, just under 2% lower to start the day. So those SQQQ calls that I bought yesterday are probably printing right now. Let's see what else we've got. Oil is at 110, down a couple of cents, not a whole lot. There's been some interesting things happening in oil markets lately. The arbitrage between Brent and West Texas Intermediate crude has closed to, well, nothing. WTI usually traded at a steep discount to Brent, although right now they're trading kind of at parity. And actually, I saw WTI go a little higher than Brent at one point yesterday. That all has to do with this breakdown in refining capacity. All right, the price of fuels has detached from the price of oil. Right? We have got record high gasoline prices right now. We've got record high diesel prices, jet fuel prices, but oil is still well below record highs. Because the problem now is not we can't get enough crude. The problem is we can't process the crude fast enough because we haven't built a refinery in this country in 50 years. All right, and that is a global phenomenon because Europe can't run their refineries because they don't have any electricity that you need to run those refineries. It's too expensive to run them. So the U.S. and India is really serving as the world's refinery right now, trying to make up these gaps in all these markets that can't supply their own fuel. That's causing fuel prices to skyrocket, even though the underlying crude really isn't going up. So some interesting dynamics at play in oil markets, something we haven't seen in a while. Keep an eye on that. Keep an eye on the gap between Brent and WTI. All right, let's see what the commodities are doing today. We've got gold is up about $11 at $18.58. Silver is at $21.97, struggling to retake that $22 mark, up 24 cents or 1.1%. Base metals are mixed, with copper down a little bit. Platinum and palladium are relatively flat. There's the crude and the Brent that I was talking to you about right now, with Brent now at 110.84, but WTI at 110.14. Again, that spread is usually a couple of dollars, not a couple of cents. Let's get this window out of the way. Natural gas is down a little bit today, but at $8.80 per million BTUs. Watch that natural gas price. Check out this chart. This is U.S. natural gas prices over the last year, folks. Straight up we go. And you could chalk this up to the cancellation of pipelines, to a decline in productivity because we're not putting any new wells in this country. There's no CapEx going in. So you've got, I'm not going to say declining production, but a slowing rate of increase in production. At the same time, you've got this insatiable thirst for LNG over in Europe now because of everything that's going on in Eastern Europe with the Russians. That's driving U.S. gas prices higher and higher. Again, one that I have been watching all year has been Cheniere Energy, ticker LNG. Full disclosure, I do not have a position in this company. I sold my position about 2 or 3 weeks ago, right around the level we're at right now. I have been looking for an opportunity to get back into this one, although I'm watching the gap between American gas prices and European gas prices. That gap is closing. That is the margins of this company getting reduced, although right now this company is trading at, in my opinion, an obscenely low multiple for what its true value is. I just don't like the technical looks of it, namely this double top that I drew a couple of weeks ago. Can you guys see my chart here? You can. Okay. So that's one I've been watching. Also, back to the commodities. Let's see what the agricultural commodities are doing today. Wheat is up about $9, just under $1,200. Corn is down a little bit at $7.78. Those are the two that I've been watching on this channel a lot. I've been in this corn ETF, ticker CORN. It's down at about 1.2% today. Just bumped into that descending channel that we've been in. Really looks like a bull flag pattern to me. We butted right up against that line, and there's your sell-off today a little bit. So we're still in this consolidation, although I think corn is still heading much, much higher. I've got my moderator, Mish, is out on the road, and he has been touring through the Corn Belt. Actually, he's kind of in the southwest of the Corn Belt. He's been going through Texas, Oklahoma, Kansas, taking pictures and sending what he's seen. And what he sees is not good for U.S. agricultural production. In particular, wheat I want to talk about here, because wheat prices right now, we've got kind of, you could argue that's a double top, although when I look at this wheat chart, let me get my sloppy drawing out here. What I'm seeing forming here is possibly cup and handle pattern. And a cup and handle pattern is a very bullish pattern, right? That would indicate, if this cup and handle completes, that would indicate a very bullish sign for wheat futures. And Mish has been driving through. He sent me some pictures over the weekend. He went through Texas, Oklahoma, and Kansas, right, which are some big winter wheat producing states. And almost every wheat field that he's driven through, now we're talking about hundreds and hundreds of miles of nothing but agricultural fields. And he's seeing nothing taller than 18 inches on the winter wheat. And anything lower than 2 feet is really not viable as wheat product. All right. And what he's seeing, he's told me, I talked to him this morning right before this live stream. He said he had a conversation with a farmer in Kansas, and basically everyone that farmer knows, every other farmer in the area, they are taking crop insurance on their wheat. They're not getting any grain out of it, and they're chopping down their fields and making hay out of it. It's basically scrap. They're making hay from their wheat crop, which means they're just trying to salvage whatever money they can out of it. So U.S. winter wheat, we're looking at a very, very disappointing crop, and that's about 70% of U.S. wheat production is from winter wheat. Combine that with everything going on in the rest of markets, with the Ukrainian wheat being off the table, with the fertilizer prices. All right, so I think wheat prices probably have higher to run. That's why I am in this ETF, WEAT. Although I'm not as bullish about wheat as I am about corn, but I'm still very bullish on both. And I just want to mention this article. Again, Mish sent this one. Thanks, Mish. You've been on fire today. Talking about avoid potential misread on U.S. planting pace in delayed states. All right, that's a mouthful. But what I want to talk about is a couple of these paragraphs that I saw down here that really jumped out at me. And they're saying excessively wet and cool weather has plagued the northern U.S. plains this spring, putting farmers in North Dakota, southern Minnesota, and parts of South Dakota far behind schedule. Final planting dates for crop insurance are rapidly approaching, and the current pace suggests some of these acres will go unplanted this year. Now that's big, because we're getting to the point where it's too late to plant corn, and right now the soil's too wet and it's too cold. So they might do what's called a prevent plant, which is basically insurance payout. They don't plant their crop and they get a payout from the insurance company. Now the problem is, they're saying here, it's important to understand how the decision to claim prevent plant may be reflected in weekly planting progress numbers. It could suggest a more productive pace than what actually occurred, or it might imply that acreage targets are sound. So what they're saying is, if farmers decide to take prevent plant, if they take their crop insurance and they don't plant that corn, then the people reporting this planting progress data will basically count that field as planted. So what this article is saying is that the percentage of planted fields that has been coming in and reported out in some of these reports, it might be artificially high because farmers have already given up and they're taking prevent plant acreage. So it's another thing to watch out for. We're already down about 4 million acres in corn this year because of what's going on with fertilizer prices and everything else, and now diesel prices, and God knows if these guys are going to be able to run their tractors or not. So crop insurance, these prevent plant acres, this could really take a chunk out of corn production in the U.S. this year. That's a story we're going to keep watching on, and we're really in this vital time. These next few weeks are just absolutely pivotal. If it doesn't dry up, if it doesn't warm up, then a lot of corn's just not going to get planted this year. And I see Mike Binder again in the Super Chats. Thank you, Mike, from Robin RC Models. He says, one thing about the upcoming CPI read, geez, I can't talk today. One thing about the upcoming CPI read, they anchor the reads on the monthly from last year. So the figure doesn't show the overall extent of inflation. That's a good point, Mike. What Mike is talking about is the base effect. All right. When when they report inflation, they're reporting a rate of change of price increases. And the year-over-year read is comparing it to last year's inflation. All right. Now, we're right at the point around April, May, June is when last year inflation really started to pick up. Right. We went from around 2% in the beginning of last year. And then right around this time last year is when we started to get the 4% and the 5% reads. So we've got the base effect. We've got higher comparable months from a year ago that we're comparing it to. So that will have a downward pressure on what the actual CPI print comes in at. But again, you have to remember is that CPI is a rate of change. Just because we see a lower CPI, that doesn't mean prices are going down. That means prices are going up slower. They're still going up. These prices are not coming down, folks. They're probably never coming down. Not until we're on some new currency, God knows whatever that's going to be. I hope it's not Fed coin or some CBDC. But that is a great point, Mike. The base effect will begin to take its toll. It's already taken its toll, especially with used vehicles, which has been one of the big inputs to the inflation reads these last couple of months. Well, the base effect has brought those used vehicle price increases down significantly, and that has had some downward pressure on CPI, even though CPI is still, what did we get, 8.3 last time? So we're still looking at some serious inflation problem, folks, even if the CPI number comes in lower. And I just want to remind you that they're still not telling the truth about the rent. All right, the rent numbers, this astronomical blowout in home prices that started in the summer of 2020, it has still not shown up in CPI. And that is the single biggest variable in the whole CPI equation is owner's equivalent rent. It's almost 25% of the whole freaking index. And it still is only showing like 4% year-over-year increases in rent. BS. Straight up BS. The rent has gone up 18 to 20% in most of these U.S. cities. So, hey, next CPI print, maybe they tell the truth about the rent. I just throw them out there. You could tell the truth about the rent. Anyways, a couple other things I want to talk about. I saw some seriously ridiculous stuff this morning coming out of Switzerland. You can probably guess. There's this big meeting going on at Switzerland where if I talk too much about it, I'm probably going to get my channel in trouble and I'll get shadow banned and I won't get any new subscribers. But this stuff, I can't get enough of this. All right, these guys, they're playing by their same stupid playbook that is no longer working. Tech route is just a shakeout, according to top CEOs who predict what's next for markets. And I got to talk about this guy. Where is he? Bear with me here. These guys are in Davos right now. And he says top CEOs and investors have struck an optimistic tone on the recent sell-off in global technology stocks, telling CNBC it's unlikely to metastasize into a broader market crisis. Tech stocks are already down over 20% this year, and they're optimistic about tech stocks. These guys don't know how to speak any other language. The tech-heavy Nasdaq closed Monday's trading day down more than 26% year to date. All right, and these guys are saying they're optimistic about tech stocks. And here's this one, this quote from this guy, Mr. Ralph Hammers. All right, he says, clearly there's a question of what should the exact market value be of some of these models, but the underlying business models are true business models, not only now, but for the future in terms of delivering services, advice, and what have you digitally, said Ralph Hammers to CNBC at the World Economic Forum in Davos, Switzerland on Monday. So he's sitting out here in Davos, knobbing hobs with the global elite, and he's pitching tech stocks. On the same morning that Snapchat is down 34%, dragging the whole tech index down lower because they have warned they're not going to make earnings. And this guy is in Davos, sipping champagne, promoting tech stocks. These guys don't know how to say anything else. This is all they know how to do. That's all they know how to do. And speaking of stupidity to come out of Switzerland this week, I also saw this one. And this is just one day's worth of stuff. Burning gas to produce electricity is stupid, the CEO of power giant Enel says. Let me guess what Enel sells. Probably windmills and solar panels. This guy says the CEO of an Italian power firm, Enel, has cast doubt on the continued benefit of using gas to produce electricity, telling CNBC it's stupid and that cheaper, better alternatives are now available. Really, Italian CEO dude? You've got cheaper, better alternatives available? Well, go ahead, fire them up. Where's your power? How come your fertilizer plants aren't working? How come millions of people are about to starve to death because you don't have power for fertilizer? Go ahead, throw the switch, turn on your cheaper, better alternatives. Where do these guys get this from? Where do the gall of these people? An energy crisis spurring a global famine is in progress. And these guys are still pumping tech stocks and wind and solar. They're still speaking the same stupid language they've been speaking for the last 20 years. I'm getting fired up, man. Speaking to CNBC, Steve Sedgwick at the World Economic Forum, Francesco Staracci discussed where Europe had sourced its gas from over the years, naming Libya and Russia. Wait, where was it? I have to find it. Yes. Alternative methods of electricity generation include wind and solar power, among others. They're still saying don't use gas for electric. They're still pumping this carbon story. No matter how many million people are about to starve to death, they're still out there saying wind and solar are cheaper. You've had 20 years to prove it. 20 years. And you have only become more and more dependent on fossil fuels. And now it's causing war and riots and coming soon, starvation. And they're still pushing wind and solar. Again, they don't know how to speak any other language. This is all they know how to do. And I have to play this one for you. This is actually scary. I'm going to go on mute for a second, and I'm going to play this video for you guys. Check this out.
We're developing, through technology, an ability for consumers to measure their own carbon footprint. What does that mean? That's where are they traveling? How are they traveling? What are they eating? What are they consuming on the platform? So individual carbon footprint tracker. Stay tuned. We don't have it operational yet, but this is something that we're working on.
Yes, I'm sure the purpose of this technology is for the individual to track his own carbon footprint. Surely nothing nefarious would come out of technology that tracks where you go, what you do, what you eat, where it came from, right? Surely governments would never, ever misuse such a technology, right? Like, surely this wouldn't be used to implement some kind of social credit score and deny people access to loans or otherwise penalize them, right? And by the way, these guys in Davos, will they be using this technology? Will their individual carbon footprints be tracked? Because they're out there eating some awful carbon-intensive, expensive food right now. I doubt they're having lentils and bugs for dinner in Davos right now. By the way, how did they all get to Davos? Oh, that's right. They take private jets to the airport, and then from the airport, they take a helicopter to the hotel. Let's see. What does my carbon tracker say about that? Oh, boy. Better go buy some more carbon credits. Muckety. Oh, God, these guys really grind my gears. Do not let them do this. Oh, my God. What's the worst thing that could happen? Don't answer that. So there's just some serious, serious stupidity coming out of Switzerland right now. Just lock the place down. Just lock them all in there. They're all in one place. Just put a fence around it real quick. Can anybody know a guy who can build a fence real fast? A really, really tall fence? Just build a fence around it real quick. Problem solved. Anyways, I'm getting a little heated right now. Probably just got myself in trouble again with the shadow banners. But we'll see. All right. Let's take one last trip through the markets. I've been going for a while. Right now, the S&P is down 1.36% or 54 points. Looks like the sell-off's gaining a little bit of steam. Dow is down 163 or 0.5%. Dow's kind of doing better than the rest of the indexes today. And the Nasdaq continues to be the red-headed step index, down 314 points or 2.73%, and all indications are still heading lower. So tech is leading the way down today. Not surprised. Again, Snapchat, an unprofitable company, doesn't make any money, has a bloated valuation, perfect metaphor for this market. And that's what's going on. The market is realizing, hey, we still are paying too much money for these tech stocks. I don't care what that schmuck in Davos said. Tech needs lower multiples. And money's flowing out of stocks and into bonds right now. And let me just verify that last part about bonds. Where's the 10-year? And yep, 10-year Treasury yield is still headed lower. That is bond prices headed higher. All right, guys, I think we are going to wrap it up there for today. Real quick, I have to mention, I am going to be in San Antonio on Thursday this week. Actually, it is Saturday. I put some information in the description. I'm flying out there Thursday. I'm meeting up with the Economic Ninja and my man Chris Taylor from Financial Fitness. We're going to do some videos in Texas, have a good time. And then Saturday night, I have the information in the description down below. We're going to be at the Embassy Suites Riverwalk in San Antonio for happy hour. You guys come meet us up there. There's no tickets. There's no cover. There's no nothing. Just come in and let's talk finances, folks. So, again, there's information down in the description below to that, and hopefully I can meet some of you guys. I know there's a lot of you Texans following me right now. I see hi from Texas in the chat all the time. So it'd be cool to meet you guys, have a drink, and we will talk finance. All right, guys, we're going to wrap it up there. I just want to send a big shout out to my Patreon supporters. Thank you guys for everything you do. Thanks to my moderators, Mish and Neil. Appreciate you guys and all the help you give the channel. And until next time, live small and dream big.